Look at your phone right now. You are holding a device built on the bleeding edge of human engineering, packed with microchips, algorithmic feeds, and billions of dollars in venture capital. Now ask yourself a brutal, uncomfortable question. Has that hyper-exciting piece of technology ever actually made you financially secure, or has it just kept you trapped in a cycle of digital anxiety? We live in an era where everyone is hunting for the next viral tech startup, the explosive crypto token, or the revolutionary disruptor that promises to change the world by next Tuesday. Yet while the crowd chases shadows and loses sleep over red and green portfolio charts, a very quiet group of investors is accumulating unimaginable fortunes buying things so dreadfully boring that your eyes would glaze over just reading their annual reports. How is it that the most thrilling investments consistently destroy ordinary wealth, while the dullest, most monotonous businesses on Earth quietly build generational empires? Stay with every second of this breakdown, because by the time you reach the end, you will realize that your own biological programming is actively conspiring against your financial freedom, and you will uncover the hidden psychological trap that separates the frantic speculators from the quiet masters of capital. If insights like this change the way you look at the world, consider subscribing to keep uncovering the real mechanics of wealth. Your brain is wired for survival, not for wealth. Thousands of years ago, survival meant reacting instantly to movement in the bushes, spotting sudden threats, and chasing sudden opportunities. That biological wiring has not changed. When you look at the stock market today, your ancient instincts treat flashing numbers, breaking news alerts, and soaring stock prices exactly like rustling bushes in the jungle. You feel an adrenaline spike. You feel the urgent, primitive urge to act, to buy, to sell, to escape danger or capture a sudden prize. The financial markets have weaponized your own biology against you. Every notification, every market crash headline, and every social media post about a skyrocketing asset triggers a dopamine loop that makes sitting still feel like absolute torture. And that is precisely why most people stay poor. They mistake constant motion for progress. They confuse the thrill of the chase with the discipline of building wealth. Enter Warren Buffett, a man who built one of the greatest fortunes in human history by doing something that feels utterly unnatural to the modern mind. Absolutely nothing for decades at a time. Buffett did not succeed by outsmarting high-frequency traders or predicting the next macroeconomic crisis. He succeeded by recognizing a fundamental flaw in human psychology. We crave entertainment in a game that rewards absolute, unrelenting boredom. Think about what happens when you buy a glamorous, hyped-up growth company. Everyone is talking about it at dinner parties. The media treats its quarterly earnings report like a championship sports final. The stock price swings wildly up and down based on shifting market sentiment. Your emotions swing right along with it. On Tuesday, you feel like a financial genius because the stock jumped 15%. On Thursday, a minor piece of bad news drops, the stock plunges, and your stomach drops into your shoes. You are not an owner of a business. You are a captive audience member in an emotional thriller where you have no control over the script. Now, contrast that exhausting roller coaster with the reality of a truly boring business. Imagine a company that manufactures industrial valves, or processes commercial laundry, or operates a regional railroad line in the middle of nowhere. Nobody writes viral blog posts about industrial valves. No tech influencer makes YouTube videos breaking down commercial laundry economics. The CEO of a regional railroad is never invited onto financial news networks to give visionary predictions about the future of human transport. They just show up to work every single day, keep the trains running on time, fix the tracks, and collect microscopic fees from thousands of industrial shippers. There is no drama. There are no midnight tweets from moody founders. Just a steady, unglamorous drip of cash flowing into the corporate treasury, quarter after quiet quarter. Why does this mundane reality scare most investors away? Because it is boring. And to the human mind, boredom feels like stagnation. We feel an almost physical itch to interfere with our investments, to optimize them, to trade them, to do something to prove we are smart. When you own a boring business that does not move for 6 months, your brain starts whispering dangerous lies. It tells you your money is dead. It tells you everyone else is getting rich on the new trend while you are sitting in the financial slow lane. That impatience is the hidden tax that destroys more portfolios than any market crash ever could. Buffett understood this deep human weakness and turned it into an unshakable philosophy. He often observed that if you aren't willing to own a stock for 10 years, you shouldn't even own it for 10 minutes. That single rule requires an extraordinary amount of psychological armor. It means completely detaching your self-worth from daily market fluctuations. It means accepting the profound social awkwardness of telling someone at a party that your portfolio consists of insurance float, candy manufacturers, and furniture stores, while they are bragging about flipping speculative digital tokens. The psychological price of admission to true wealth is looking foolish to the short-term crowd while quietly winning the long-term war. Let us look closer at how this plays out inside the mechanics of these unexciting enterprises. Take the concept of pricing power, which sounds like an intimidating corporate term, but is actually a profound reflection of human habit. When a company builds a product so embedded in daily commerce that customers cannot live without it, but so small in cost that nobody notices a price increase, they possess a hidden economic superpower. Imagine a company that makes specialized glue used in automotive manufacturing. An entire car depends on that glue holding structural components together under extreme stress. If that glue fails, the car falls apart on the highway. Now, suppose the manufacturer raises the price of that glue by 5%. Does the car company switch to a cheaper alternative? Never. The risk is astronomical compared to the trivial cost of the glue. So they pay the higher price without a single complaint. Multiply that tiny, invisible transaction across millions of vehicles, and you get a torrent of cash that flows directly to the bottom line without requiring any marketing budget, any viral social media campaigns, or any genius innovation. The business model runs on pure customer inertia and psychological dependency. Competitors look at the boring margins and stay away because there is no flashy glory to be won there. The incumbent sits quietly in the middle of that friction-free zone, collecting their toll year after year. Yet human nature makes it nearly impossible for ordinary people to replicate this approach on their own. Why? Because we are addicted to the narrative of the hero founder. We want to believe that a charismatic visionary is going to lead a company to the stars. We want a story. We want drama. When you buy a boring stock, there is no hero. There is only a balance sheet, a ledger, and the cold, unyielding logic of cash generation. There is nothing to talk about at the water cooler. There is no heroic narrative to feed your ego, and that is precisely why it works. When you remove ego from investing, you remove the catastrophic mistakes that ego causes. You stop trying to prove how smart you are. You stop chasing high-risk bets just to feel the rush of adrenaline. You embrace the quiet power of mathematical compounding, which Albert Einstein supposedly called the eighth wonder of the world, not because it is flashy, but because it is relentless. Compounding is like freezing water in a crack in a rock. At first, nothing seems to be happening. The temperature drops, the water turns to ice, but the rock looks entirely unchanged. Passers-by walk right past it, assuming nothing is taking place. But behind the scenes, expansion is occurring at a molecular level. Pressure is building quietly, invisibly, persistently. And then, one morning, with zero warning, the massive boulder splits cleanly in half. That is what compounding does to capital when it is left untouched in a boring, high-return business. The first few years look flat. Skeptics mock your patience. Impatient investors pull their money out to chase the latest shiny object down the street. And then the exponential curve kicks in. The wealth multiplies not by addition but by geometric progression. By the time the crowd notices what happened, the gap is so vast that it can no longer be bridged. The tragedy is that most people never experience this because they lack the emotional fortitude to endure the quiet middle chapters of the story. They sell too early out of boredom. They panic during normal corrections because their psychology was built for survival in the jungle rather than patience in the market. They trade away their greatest asset, time, in exchange for the hollow, fleeting excitement of immediate action. As you let these truths settle into your mind, the frantic noise of the modern financial world begins to look very different. You start to see the flashing screens and breaking news alerts not as valuable information, but as carefully engineered distractions designed to separate you from your capital. You realize that the real game of wealth is not played out there in the screaming arena of public opinion. It is played out in the silence of your own discipline, in your willingness to embrace the unsexy, the monotonous, and the deeply, profoundly boring.